Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, November 15th, 2022. Welcome back to the podcast, George.
Great to be back on.
Always good to have you. And, no shortage of things to talk about, as has been the case for the entirety of the year. But since your last podcast, markets have literally completely forgotten about the hawkish FOMC meeting and instead have totally embraced the pivot narrative once again, obviously coming after that softer than expected CPI reading. I know you've been pushing back on this idea really and really for a while, but also locally. One number doesn't make a trend. More importantly, even if inflation is peaked, Chair Powell was really explicit, said it's going to take more than a few, let alone just one improved inflation reading for the Fed to feel confident they've won the war. All that seems very valid to me, but I think the question for you is the framework still valid in light of the better than expected CPI and also today's PPI reading? That also came in softer than expected. And more generally, how should we be thinking about the Fed's reaction function in light of the developments over, let's say, the last couple weeks?
No, it's been an amazing turn of events. Again, yes, this is 2022. We're coming to the end, and it's not letting us down with all the kind of twists and turns. Look, I think we need to take a step back, and I've been taking the approach that you take the Fed at face value, and that they haven't really deviated from the plan that they set forth earlier in the summer and all throughout, and even the most recent Fed meeting. Because at the end of the day, what really matters is where does the Fed end up going to? What is the terminal Fed funds? And how long do they stay there? That's really what we're all trying to solve for. And I think we need to take a step back and realize that at face value, the things that Chair Powell laid out in the last meeting, again, pre-CPI, but we can get to that in a second, I still think holds, regardless of what's happening here on the inflation front. And one of the main reasons why I feel so strongly about that is that Chair Powell being both a student and a person that's lived through the 1970s, we are kind of informed and as well formed by the experiences of our past. And I think Chair Powell's experience in the 1970s, and also just studying that, is almost kind of akin to Bernanke having studied the Great Depression and how that really helped him work through the financial crisis. I think there's a similar kind of parallel happening there with Chair Powell, that they don't want to repeat the 1970s. And in the 1970s, the biggest mistake the Fed did was to quickly reverse course after seeing inflation start to head lower a little bit for 18 months or so, and then they started easing policy too quickly, and then that led to an even bigger inflation move on the back of that. And this is something you and I have discussed over the course of the year, that the second and third wave of inflation could end up being much worse than the first one. So I think they have that as in the benefit of history. I think that they are true to form. We take them at face value. They want to move into they have moved into restrictive territory. They want to go even further. That it's no longer about the question of the speeds of the hikes. It's more about how high and where they end up getting to. And so fine, they're going to probably step down to 50 basis points, which in any other hiking period would have been a lot anyway. And then eventually down to 25, and perhaps maybe pause after that or keep going, depending on how, where inflation stabilizes. Because one thing we don't know is that, yes, it does start to feel like inflation has peaked. Some of the internals suggest that we've probably seen the most of it, at least for now. PPI, you're right, this today also kind of confirms some of that move. But does it stabilize at 4%, 5%? Any of those numbers is still in the wrong zip code when it comes to the Fed. They need to get down towards 2. And I think it's going to require them to be on hold for longer and at a higher level of rates, which we have not seen, and markets are just not prepared to accept, in my opinion. So I do think that, one number doesn't make a trend. They're going to wait to see a number of inflation readings through December into the early part of Q1. We're going to get new forecasts for the dots in December, which might give us some indication on the terminal. So I really don't think we can extrapolate this, this trend and assume that the Fed is going to back down and start to, unwind the hikes, let alone, stop. So yeah, too soon in my opinion. And I think the markets, really are suffering from kind of this euphoria around that potentially now the coast is clear. And in fact, all this was more like a positioning realignment. Markets were really short in both asset classes like rates and risk, and that caused this really huge impulse. I think it's going to fade, as long as the Fed stays true to form.
Yeah, and that positioning, that short covering, adjustment you talked about in your piece earlier this week, I thought that was critical to understanding, how vicious the move was on Thursday. Seems like you're saying that the markets might be, the Fed might be pivoting a little bit in terms of like talking about, moving from a 75 basis point hike to a 50 basis point hike, but they're certainly not pivoting from being hawkish and focused on inflation and pivoting to worry about growth. Like that's very premature from what you're saying, and that resonates with me. To kind of continue on the same topic, but to elaborate, I'd point out your recently published piece in the Global Markets Monthly. In the piece, you suggest that it may be time to start averaging into U.S. fixed income. Why don't you go through some of the high points for our listeners? And I also know you're going to be going into more detail on this on your 2023 Outlook piece, which I know you're working on. Don't want to steal the thunder there, but why don't you also take us through some of the scenarios you're contemplating, and how that impacts, what next year looks like?
So first and foremost, we're still of the view that given this level of tightening, the cumulative effect and what still lies ahead, and the fact that QT will be ongoing, and even though we've seen the dollar kind of reverse course over the last week or so in a pretty meaningful way too, all of this tightening, this lagged and massive amount of tightening that's happened all throughout 22 will still show up in 23 in our view. And I think that the odds are pretty high that we're going to fall into a recession, both from labor is going to come down, production, housing is getting hit. So it's going to be a broad enough kind of impact to the economy that we can qualify as a proper recession, not just a technical one that we had in the earlier part of 22. And I think that will, that's in such an environment, fixed income after having one of the worst, if not the worst year in history, the comps look much better when you start to look at it for 2023. So I do think that's why I've kind of labeled this idea of dollar cost averaging. It's something we've been saying even earlier in other publications, especially around mortgages, and whenever rates do back up in the long-term part of the curve to start to average in or receive in like the distant forwards, I think that still makes sense, and that's been my view since we've been above 4.25. The problem I have now is that we have the 10-year sub 4%, and the Fed's not done yet. So I would not be recommending that necessarily expression at this point in time. I think the market, again, based on my thoughts around the Fed as well as how to think about inflation and the growth path into early next year, it's too soon to be having the duration trade on and in a very big way. But yes, you can start to average in whenever we do see decent backup in rates. Once we maybe go right back above 4% again, we'll see how far rates can go. I think that's one way to think about it. The other part too, which is this is all about the finding a way of being internally consistent. If rates are going to be rallying from here further, then that's really going to be the markets expecting a decent slowdown in the economy and the Fed eventually having to ease rates, but also something has broken or something will be breaking. Either it's the labor market or something's happening in credit or something's happening in the equity market, and that's forcing flight to quality flows. Like that needs to be like the precondition in my mind to really see a bigger rally from where we are now. So I'd rather be buying on dips or larger dips in fixed income. But things like mortgages have had a really tough year this year, and I think averaging in there whenever they dip probably is okay, regardless of the level of rates, as long as you're doing it on spread. And even in IG, there's some opportunities as rates back up and also spreads widen, you do the same thing. So basically, it's like a high quality dollar costing averaging approach, not going full into these products, but looking for opportunities whenever there is a cheapening that happens around either an event or just kind of preparing to the next Fed hike in December, for example, or the February 1st hike, if that ends up being the last one. I mean, I think the window is starting to open up where you can start to think more favorably for fixed income next year, because you're getting paid enough yield, a decent amount of spread, especially if they widen again. And we haven't seen these levels for so many years, and carry should be okay in the second half of 23 into 24 if the Fed does cut rates. So the conditions are much better now to start to think constructively for high quality fixed income. For high yield and for the other more levered parts of the credit system, we're not there yet. We're nervous about the outlook for the economy, so it wouldn't make sense, especially because high yield and equities would probably have a decent correlation if they were to see one final decline into an economic slowdown. So still defensive, looking to average in, but really not suggesting to do it at these levels, but looking for opportunities over the course of the next 3 to 4 months.
Yeah, that makes a ton of sense. The yields are, I don't know, like 300, 250 to 300 basis points off like lows of about a year ago. That all the pain, this past year in fixed income, certainly the forwards look a lot better. So it sounds like you're thinking constructively for higher quality assets, but still looking for a better entry point. Whereas you think the worst could possibly still be to come in the lower credit quality instruments. That certainly resonates with me. I mean, I'm looking at the S&P's, trading right about 4,000 right now, which is, which still seems like a little rich, at this point in my humble opinion. So, again, we highlighted this earlier in our conversation, but I would encourage our listeners to check out the MUFG Global Markets Monthly, and specifically George's U.S. fixed income section entitled "Time to Dollar Cost Average in?" And if you aren't receiving George's strategy reports, please feel free to get in contact with him directly. Great stuff as always, George. Thanks for coming on the episode.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.